Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Girish Nadkarni, former CEO of Clean Energy Ventures. Girish, could you take a few minutes to share your story and how you got to where you are today?
Thank you, Nicola. Real pleasure and privilege to be here today. If you look at my background, it's pretty unique in that I have worked in many different industries. So I started my career as a lawyer on Wall Street, focusing on M&A and banking, and I didn't particularly enjoy it. And I went back to business school. And then I spent some years on the investment side at Prudential doing leverage buyouts, workouts, etc. And then I found myself on the healthcare side within Prudential, and then I moved to GE Capital. And so again, doing deals and doing private placements and M&A, things like that. So being on the deal side, a large part of my career. And during that time, this was just as the internet was happening, and I discovered the internet. I just fell in love with it, saw the applications for financial services and healthcare, etc. One thing led to the other, and I was recruited by United Healthcare, which is one of the largest managed care companies in the US. And I became their chief operations officer and ran their e-commerce strategy, their e-health strategy, and ran their backroom operations, etc. And as part of that, this was during the dot-com boom, and I decided that I wanted to be an entrepreneur as well. My plan was to be a billionaire in 3 weeks. And so I left United Healthcare and did my own startup. And I have to say, one of the things I learned one is timing is everything, right? And in technology, particularly, as somebody much smarter than me told me, being too early is the same thing as being wrong. So back in 99, 2000, we had created a platform which today would be called cloud computing, and we call it application service provider. Then we had a SaaS model, which we call the pay per employee per month, etc. But it was too early, and a lot of people struggled to understand what we were offering them. Today, you take a lot of these things for granted. The other thing was 9/11 happened. And once 9/11 happened, funding just froze, and there was absolutely no one funding anything. And if you were not ready, if you were not cash flow positive, you were basically dead, which we were not. And so we essentially had to sell ourselves at like pennies on the dollar and moved on. So that was a significant lesson learned. And so I did get some entrepreneurial back experience there and dealt with VCs, but from the other side of the table. And after that, I was funded by a private equity firm to do a roll-up in the healthcare industry, but somehow that never happened because we never found the platform acquisition. And then I moved to a company called ABB, which many of your listeners may know, based out of Zurich, but it's a global company in engineering in this smart grid and automation space. And amongst other things, I ran some of their robotics businesses. And when the 2008 crisis happened, I realized this was a great time for us to be contrarian. A new CEO had joined a year ago from GE, somebody I'd known a little bit about. And I felt this was a great time and he was complaining about a not invented here syndrome, which all large companies have. So I wrote to Joe Hogan and I said, hey, Joe, this may be a great time to start a corporate venture group. A, we're sitting on a lot of cash. B, because of the financial crisis, all the other investors are sitting on their hand. It may be a great time to go in, great valuations and great opportunities. And you complain about a not invented here syndrome, and this is something to address it. And so we started ABB Technology Ventures back in 2009. And one of my first hires was Kurt Kaltenegger, who is now running ABB Technology Ventures. He was at that point head of R&D in China, and one of the best people I hired, extraordinary, technically competent people. And over the years, hired a lot of people, including one of the stars I had was Grant Allen, who now runs Schneider Ventures. And then I got recruited by Total Energies to come. So I moved from Zurich to Paris. And the reason I moved there was things were getting a little difficult at ABB from a financial perspective and other things. And I also wanted to move into the energy climate space. And I thought also living in Paris would be terrific. Maybe my wife will forgive all my sins, past, present, and future. And it was just an extraordinary time to come there. I'm happy to chat about what we did there, but that's how I found myself into corporate venturing.
Thank you. I think this is more than I knew about you. So thank you for sharing the journey. One thing that comes across also in your journey is you really got a lot of experience on the late stage side before moving into the early stage. And
Yes.
even at Total Energies, actually, you were quite nicely balanced in building the portfolio. So can you share about your best practices in terms of thinking about early stage, late stage,
Yeah. Yeah.
and how the skill sets need to be different?
That's a great question. You're right. My early part of my investing career has been leverage buyouts, M&A, and things like that, which is even beyond late stage. They are more growth companies. Or I spent 2-3 years doing workouts, which is all the LBOs which had gone bad. Working with the investment committee, with the credit committees, and I had a portfolio of about 15 companies at various stages of bankruptcy or workout. That's also an important lesson as to what could go wrong and how do you protect yourself in case things go wrong.
You've seen the ugly.
Exactly.
Yeah.
As they say, when Mercedes drives its car in a Formula One race, it learns a lot more about the car in that one race than it does in 10 years of driving. So it's the same thing when you do workouts or bankruptcy. Okay. I would say at ABB, we said we are stage agnostic. But when I came to Total, what I did was I created what I defined as a barbell strategy. And as we all know, in venture investing, you have three basic risks. You have the technology risk, which is, will it work? You have the market risk, which is, even if it works, will the market be willing to buy it and pay a premium for it or pay a price for it? And the third one is financing risk or funding risk. And in my experience, even though technology risk does exist, more of my companies struggle with market risk than they did with technology risk. Okay. Particularly on the industrial, in the B2C world, 6 to 9 months, whether you're going to be successful or not. There is no struggling 5-year-old B2C company. Okay. But in the industrial and the energy space, as I like to say, it takes you 20 years to be an overnight success. And so market access and market penetration and customer acceptance is a big issue. There are all kinds of issues from infrastructure, switching costs, etc. And so for me, the bigger challenge was market risk. So what we decided is, look, we're not going to invest in a company unless they have at least 5 million of revenue. Okay, not pilots. We did that mistake before, investing in a company because they had 15 different pilots, and then we realized there was something called death by pilots.
Yes.
And pilots don't always become revenue. So we said, look, we want 5 million of revenues. It's not a bright line, but basically that's the range, because it tells us there is market acceptance. It tells us there are paying customers, etc. And there is a product market fit. I don't care whether you call it, series A, B, X, Y, whatever. That is irrelevant. The issue is, have you made that jump? Okay. Yeah. And then we put a certain amount of money in very early stage companies, seed, pre-seed, which we felt had the potential to be highly disruptive, either because of their technology or because of their market, the business model, etc. And you invested in it. And if it didn't work out, that's all we lost. And so this is how we came about. Okay. Now, the challenge I find is not too many people are willing to invest in very early stage. Okay. And particularly funds raising money for early stage companies find it far more difficult to raise funds. Okay. You go to the pension funds, you go to the institutional investors. Oh, we don't do that. We don't do this. It's too small, too early. And so basically the problem is everybody wants to pluck the fruits and enjoy them, but nobody wants to plant the trees. And that is a major challenge.
That's a good analogy. And so the barbell strategy is very interesting for me because you get to access all the very early innovations, but very fragile, but you get access to it. And then you invest when you have real revenue. And the golden nugget is, don't get fooled by thinking that pilots revenue is customer revenue. Correct. And so that I think is really meaningful. But what happens in between? Is it because you feel like the market acceptance is too uncertain that you wouldn't want to do it? You could argue that you want to do across the full stages. So barbell for me it totally makes sense for the early stage and the 5 million revenue, but why not even look at the one in the between?
As I said, the risk is too high. We don't really know how long will the market take, if at all. to accept the product. Okay. And I've seen this happen where you think it's the most brilliant product, the market needs it, but somehow the dog doesn't eat the dog food. Okay. I haven't been fully able to understand it, but it happens. Okay. We have had many companies like this where we see the need, the customer says there is a need, but they're just unwilling to pay for it. And so the question is, how long can this happen? How long? It becomes a race between burn rate and adoption rate.
Yes.
And startups can't afford that. Okay. Now, there is a famous case study at IMD and other places about these coffee pods. I forget the name now. I don't drink coffee. Espresso, whatever. Nespresso. And it's a very interesting case that it took them a very long time. Today, everybody assumes it's the most obvious product, but if you look at the case study, it really took a long time for the market to adopt it. But to the company's credit, they kept at it. Okay, so that's one thing. But the second thing is they put a lot of capital in it to survive. But a startup doesn't have that luxury.
Yep.
Okay? And then what you see very often, and I have to tell you, as an entrepreneur, I fell to the same problem, which is you create a product and the market doesn't go for it, and you say, oh, maybe it needs these two extra things, and then you add that, and then it doesn't work. If only it had this application or this functionality, then the market would take it. And you keep adding and you keep adding and you keep spending money on your product development, which is why the whole notion of minimum viable product market fit, beta, all that is very important and you have to have the courage to say, if the market isn't buying it, either the market isn't there or there is some reason it hasn't developed and maybe we just need to walk away.
So I think the golden nugget I'm taking from this is this 5 million revenue from customers give you a timing predictability. And also it moves away from the value creation to the value capturing.
Correct.
You already, okay.
Absolutely. A good way to put that.
How did you at ABB ensure that you were first getting innovations from the outside, but also if there was a NIH DNA there, how did you manage to percolate through it?
Look, that's in some ways the heart of challenge most CVCs face. Okay. So look, I'll give you a couple of examples. And then, so once we brought one of the early days of ABB Technology Ventures, we were looking at a certain deal and we asked one of our, ABB had 1,500 PhDs, if not more. And we asked one of the top PhD guys in R&D to take a look. And the guy pestered him, and then a week or 10 days later, he says, oh, it doesn't make sense. Okay, fine. The guy is smart. He knows what he's talking about. We told the company it doesn't make sense. Our people don't think it makes sense. And the company called back and said, we don't understand this because nobody has ever accessed our database. Okay. So the first lesson was this guy just was shooting from the hip, okay, and didn't really take the effort, okay. Then over time, we realized that when the R&D folks said, oh, it does not work or will not work, what it really meant was we tried it ourselves 5 years ago. We couldn't do it. And therefore, we don't think anybody else can do it because we are so smart, okay? And you know what? Sometimes they're right and sometimes they're not. I'm not saying R&D is right all the time. I'm not saying R&D is wrong all the time. But you got to be able to understand and sift through their biases, okay? And so what I often insist in that time is to say, okay, you may be right. What I'd like to do is have a call with the company, their top people, and maybe some of their existing investors who have invested. Obviously, they have done their due diligence. And I'd like us all to have a conversation, which is what did they see to invest, which we are not seeing, okay? Sometimes you are right and they have missed something, and sometimes they are right and you have missed something, okay? But it's important to have this conversation to say, why are we at a different place? And sometimes we agree to disagree, right? But at least it is a thought through discussion, etc., and not just playing to your biases.
And I can see there's a lot of collaborative spirit in what you're describing.
The other thing I would also say is very often we have been to businesses and say, hey, look at this, okay? Oh, we have no interest. It's not on our product line, etc. And my attitude is, okay, fine. I see where you see, my job is to look around the corner. Your job is to focus on the next quarter or the next year. Okay. So you may not be interested or even be aware of what's happening 3 years or 5 years from now. Okay. But that's my job. And if I think that's where things are converging, even if you don't think that's important to you today, I will make an investment, because 3 years from now, you will thank me, and which invariably happens. Okay. So I remember when I moved to Total Energies, the person who headed the downstream business, or they call marketing and services, did not believe in EVs. He didn't think EVs made any sense, will never succeed. And I said, you know what? That's fine. That's your view, but I do think they will work. And so we will make EV investments. And guess what? Now they realize that's very important. So you have to be able to say the future is somewhere you're not either aware of or focusing on, and we are going to create. And so remember, the single most value which a CVC brings is to create optionality.
Yes.
Okay. Now, in my experience, having worked at a number of companies and CVCs and advised many, what's very clear is that the companies or the divisions or the BUs which will support you and give you some leverage or whatever is the ones who are facing a burning platform. If they're facing a burning platform, whether it's in mobility, whether it's in e-commerce, whatever, then, and that platform is being burnt by startups, suddenly they are very interested in what's happening.
Yes.
But if they are in a stable business and doesn't look like it's going to change except on the margins here and there for the next 5-10 years, they have less interest because it's not urgent for them. It's not moving the needle for them.
So I'll go back to the burning platform, but I want to capture the golden nugget of optionality. And the way I hear from you is it's this nice combination of strong conviction that you need to build as a CVC and the humility that you may be wrong. And once you do that, it's about building that optionality that business groups need to appreciate is a mission of the CVC. So you mentioned very early in this interview about timing is everything, and being too early is the same as being wrong. And what I find interesting, and that connects with that very cheap optionality, is corporate VC and even financial VCs needs to be right maybe 2 years early before it's obvious to everyone else. The luxury of being early but not too early compared to a corporation that can't afford to be too early.
There is always a sense of FOMO, okay, which is the fear of missing out. And so you want to time it just, you're too early, you lose, or you take too long, or take too much capital, you wait too long, etc. You know, FOMO may work in some industries, but I think in industrial and others, you don't have to worry too much about FOMO because things don't change that rapidly and that quickly. Okay. The other thing which I did in managing Total Energy Ventures was bring in some of the sensibilities of a private equity world. Okay. What do I mean by that? In the typical VC, maybe when you're investing in social media and one of those things, you say, I don't care if 9 of my companies fail, so long as the 10th one is a Google or the Apple or whatever. Okay. The problem is in the industrial and energy space, there are no Apples, there are no Googles. Okay. So you need to make sure that you're getting success across the companies. And the best way of ensuring is you don't lose money. So my first mandate was, first, let's play defensive. I just want to make sure I don't lose money. Okay. And I'd rather have 5 companies with a 3x return than worry about that one 10x return or 100x return. And so very often we would, even where the company has not had an exit and maybe there's growth stage financing, and if somebody is wants to do a recap, etc., or a big growth investor comes in and says, look, I want to buy, we are more than happy to sell out at a 3 or a 4x, because a 3 or a 4x certain in my pocket to me is far more important and valuable than a potential 10x down the line. Okay. And I've been in this business long enough to know what the signs are of market being at the top. Okay. When you have hedge funds coming in, when you have mutual funds coming in, when you have the non-traditional investors coming in, it's the time to run away.
And that's a golden nugget here.
Absolutely, without fail, without fail.
Wow. So I want to double click because intuitively I can see why, if you have an ability to lock a 3x or 4x, you should take it. But I can also see why the audience might think, wait, maybe it could go even higher. But yet, as a corporate VC, you also want to show success stories, you want to show proof points and so on. Can you walk us the trade-off you have in your mind when you want to lock a win versus keep it running?
I think the first issue, as you rightly point out, which is unique to CVCs, which is not for the VCs, is to demonstrate to your bosses that you are successful, okay, and to see that cash coming in. And in fact, when I was brought to Total Energy Ventures back in 2017, and Total Energy Ventures has been around since 2009, but their early part, they were investing in clean tech 1.0 and in a lot of stuff in very difficult sectors, biofuels, algae, battery systems, etc. And the smart people doing good deals, but it was just a very tough environment. And as everybody discovered, this thing takes coming from the dot-com boom to this, everybody realized a little late that this takes a lot more time and a lot more money than just throwing 6 programmers to solve a problem. And so our CEO, Patrick Pouyanné, said, look, all I've seen is money going out. I've not seen any money coming in. And so I want you to make me money. Okay. And so there is an imperative where you have to show money coming back in, even if it is not the highest amount. Okay. Now you could argue, is that a smart thing to do or not? You also have other constituencies, etc. The other aspect of that, even putting aside the corporate venture group requirements, is if you see that the company is truly doing well and is hitting on all cylinders and the exit markets are there and potentially an IPO, then you might want to run with winners, okay? Or you take some money off, you cover your cost of investment and you let the rest ride. It's a little bit like what's your gambling strategy when you go to Vegas or whatever. There's this concept of house money, etc. But if you see that, that all this is overvalued and there's no real viable exit there, you have to realize that the IPO market is very tough, okay? You're locked up for 6 months, right? And so just because you can go IPO doesn't necessarily mean that you're going to get it at the IPO price. You're going to see where the market is, how frothy it is. From a trade exit, which company is going to pay that kind of multiple? If I'm Schneider trading at 15 times earnings, or if I'm BP or Shell or whatever, why would I be paying 50 times revenue for a company? Okay. Now, if it's a small company and I'm just paying 30 million for something, I really don't care what the multiple is, because all I'm really doing is doing an acqui-hire or buying something for the platform. But if you expect me to pay serious money, valuation metrics do become an issue. Okay. And so if I feel that market is overvalued, okay, and everybody loves to have their company be valued, but if I think this is a reasonable price, money in the bank is better than money is still in the company. Now, there is a different experience. I said to you that our CEO said to me, I've seen only money going out. Now, we had an interesting situation at Total Energy Ventures, this is before my time, where they had invested in a company in the sustainable aviation fuel business. Company went public, and they were at one point sitting on profit of $60 million. Okay. They wanted to sell that venture group, saying, look, good price, good valuation, etc. But the business said, no, this is a strong strategic, company crashed. When I came on board, I essentially cleaned up the portfolio and sold that company's shares for $7,000. Okay.
Oh my gosh.
Now, so I created the following rules. First, if a business wants me to do a transaction which I don't think makes sense for me financially, but I am being persuaded or to do it because it's good for the business, I said, fine, I'll do it. It's important that we have a strategic. But Mr. BU manager, I want you to give me a put agreement on this deal. If this deal craters or crashes, I will put my shares back to you at my cost. Okay, I've done that at Total. right? So I don't want to bear the risk. If I'm being evaluated on what my performance, I want to decide where I want to invest. Okay, I've done that. Then we were very fortunate that because of our barbell strategy, when the SPACs happened, we were very well positioned for that. And we had almost 11 exits in 18 months. That's some of the most ridiculous valuations.
I remember we were talking at the time. That was pretty amazing.
So my view is the moment a company goes public or whatever, right? I want to sell. If there's an exit event, I want to sell, particularly if a company goes public. I am not in the business of riding the shares up. I'm not a public company investor. I'm not tracking the market. I don't have the expertise to know this is a good time or bad time, okay? I may be leaving money on the table, but I'd rather say, look, it's a rule. Nobody's second guessing me. Sometimes I may be right, sometimes I may be wrong, but I'm doing it. Again, we had an investment in a company which went public and we wanted to sell the moment we had the lockup was over. The business which was interested said, no, we're strategic for us. We want you to stay on with it. I said, fine, let me sell it to you at market price. Oh, no. I said, basically what you're telling me is you want a strategic benefit at my expense, or you want to leverage me. I said, you're welcome to buy it from me. Okay. And then, of course, then they back down. So you got to come up with some of these approaches to make sure that your interests are well protected. Otherwise, it gets very difficult.
No, I think it's a lot of golden nuggets and even ideas about how to engage with a business group that want to force an investment, which I call kissing the frog, or wanting you to keep when it makes sense to sell. Yeah. And I like your rule-based process because maybe sometimes you're right, maybe sometimes you're wrong, but you have at least the rules that people know you're going to abide to. Yeah. Thank you, Girish, for your time. You shared a lot of golden nuggets on corporate venturing. So thank you so much for your time today.
Thank you, and appreciate the opportunity.